Hey, greetings and welcome to the May 2024 Investment Strategy Brief. With everything going on, we're going to focus back on this concept of interest rates being higher for longer. Let's jump into it. We know that there's a lot of optimism in the environment. We've talked about it a lot. It's really around artificial intelligence to start. Now, we relate that, as I've said before, to our long-term investment themes. It's anchored in what we call our fourth industrial revolution theme, where technology and innovation is really blurring the lines between our sort of physical, digital, and biological worlds. But that AI influence is hitting all of our major themes in a big way. And, again, just to think about what's going on, because of the introduction of AI, we're going to see impacts on the economy, a sort of a transformation of the labor market over the coming couple of decades for sure, an increase in productivity, and that's going to fuel one of the themes that I just mentioned, the idea of productive competition. Now, as we've discussed before, we kind of anchor our AI investment work into three categories right now: the enablers, the backbone of AI, like semiconductors, data centers, energy, things like that. But then there are the innovators, businesses, companies that are using AI today to improve their businesses and their offerings. But then as we look out, we're going to have disruptors, basically the revolution of AI, where there will be specific efforts to almost take over segments of industries or full industries, or markets or whatever, as it relates to sort of AI-powered capabilities. Now, we know that AI is learning on data. There's tons of data being created every day, and I think importantly, we know that there's ever-increasing power when it comes to semiconductors and essentially processors, computers. And all of that's super important sort of for the continued growth of artificial intelligence. As it relates to the impact on the economy, as we've discussed before, by 2030, it's estimated that the economy will have grown an extra $15.7 trillion, with a decent amount of that as a result of improved productivity. But the bulk of it, the majority of it at least, so 9.1 trillion of the 15.7 was modeled out to be related to the enhancement of products, so different kind of AI capabilities. We know that while there's a lot that'll happen in the future, so much of it is happening today. We've seen it in healthcare when it comes to drug discovery or diagnoses. We see it in agriculture when it comes to precision farming and things like that. We see it in the industrial sector when sensors are being put on equipment that allows the systems to kind of predict before failure might occur, for example. And then in aerospace, things like augmented reality to help technicians really deal with repairs and servicing of equipment, things like that. So that's sort of the positive force at work. But the negative force, which is going to relate a little bit to the idea of higher for longer, is number one is fiscal transition. So this idea that these higher rates should slow things down, it's going to create some friction. As we've discussed before, the economy overall has added just a ton of debt since the financial crisis, really in an environment where rates were much lower. But as we've discussed before, market expectations are for rates to stay high. And this happens to be the 10-year Treasury on the upper right of this slide, showing that it's around 4.5% roughly in the current environment. But when we look at it, the 10-year forward rate 10 years from now, that the market's expecting the 10-year to be at 5%, and in 20 years still at over 4%. So think of it as higher for longer based on this analysis, and that means the consumer, businesses, and the government all have to deal with a higher cost of debt, and that's going to create some friction. It's the kind of thing we're watching for a slowdown. In fact, as it relates to the consumer, it's not really easy to see here. We've got a 3-month rolling retail sales number, but a recent print went negative, and we'll see if that is sustained. But when it comes to forward-looking things like a confidence or also just generally sentiment, basically there's been a downturn with the consumer. And we also see an increase in delinquencies, right? So people struggling a little bit to pay their debt. So we're watching the consumer very, very carefully and watching for a slowdown. Now, another sort of negative out there, unfortunately, is the geopolitical risk and tension sort of environment. We know, for example, I'll get to this later, that the U.S. and China, the competition of the trade there is going to be influenced, for example, by the upcoming election. And there's a lot of tension in the relationship. Financial instability is really intended to capture that idea of fiscal transition and some uncertainty as it relates to debt, not only in the U.S., but really around the world. But then, of course, we always want to acknowledge the tensions and issues with the wars that are going on. So Russia, Ukraine, and Israel, Hamas. And on that latter one, we've modeled out, as I think we've discussed before, different scenarios where the greatest risks relate to escalation. So we saw a little bit of activity between Iran and Israel. That's sort of calmed down a little bit. And so what everybody's monitoring for is especially Iran getting more actively involved and or maybe in the wake of that, major powers getting a bit more involved. And we don't see those as high probability outcomes, but there's tension there for sure. And those are scenarios that we have to be mindful of. Of course, if it were to occur in a more active way, that has implications for the global economy and the markets, really anchored and centered to a good degree, especially as it relates to that first step of a greater Iran escalation of essentially higher oil prices, which feeds a lot of different costs. Now, speaking of costs, let's get into inflation and Fed policy. And this is another sort of anchor to this idea of higher for longer. So to start, a lot of what sort of caused the increase in inflation is basically in the wake of the pandemic reopening and a lot of fiscal support out there, and monetary support too, but fiscal support. But think of it as lots and lots and lots of jobs being created and made available, and to a point where the worker is in a little bit more strong position in the sense of wages going up, companies having to bid up wages to sort of attract workers. And as it relates to sort of trying to find a job, there's a point at which there were almost two jobs for every person looking for work. And the normal level is that it's not even 1-to-1. There's like 3/4 of a job for every person looking for a job. And so normally, it's not quite as tight a labor market. It's been very tight. It's improving. You can see that blue line is signaling that it's round numbers about 1.4 jobs for every person looking for a job. And so there's a little bit of softening, but think of it as between wage growth and sort of that confidence in terms of employment. The consumer has been spending, they're confident bidding up prices basically in different parts of the economy, and that's leading to inflation. In fact, when we look at inflation, we look at this chart every month. This is basically rolling 3-month data for consumer price index and the producer price index. And what we see, we can kind of dig into the different patterns. And so, there's a period in 21 and 22 where things got really elevated. But the bottom line is that the Fed wants to see these bars down around the green line, and they're not close enough. So think of it, and that green line, by the way, is a monthly equivalent of the Fed's 2% target. So when we look out to the right on this chart, what you can see is a resurgence. And again, these are 3-month rolling averages. And, without getting into the details too much, what you can see visually is that inflation is running about twice as hot as the 2% target. So round numbers are around 4% annualized, and that's too high. The Fed has sort of signaled, look, we got to see improving inflation. We haven't seen it yet. When we dig into the data, this is just a slightly different way to look at it. We're looking at a line chart against that 2% monthly equivalent. The top half is data we just showed you, or at least CPI and core CPI, and core taking out energy and food. When we look at the bottom half of the page, one of the key takeaways is shelter. Basically, what we're seeing is that shelter, so rent, owner equivalent rent, has stayed elevated. And if you think about it, if you know people out there, when people say, oh, it's time for my rent to renew, or people are turning over and moving, what we know is that landlords continue to hike rents. And we're waiting for that to cool down, basically. Interestingly, when we take shelter out of core CPI, you can see that blue line is getting reasonably close to that Fed's 2% target. So shelter remains in focus as it relates to inflation. We know the Fed's watching it very carefully. And just as sort of a side note on inflation and that pattern of inflation, some of these drivers, essentially commodities, generally speaking, have had a sort of a positive move in 2024. oil being an anchor to that, but you can see some precious metals, some metals, gold and copper here up a bit too. And the bottom line is that when inflation heats up, remains a little higher, commodities can get bid up. We have other forces on oil like that Israel-Hamas conflict. So things that we're watching as it relates to inflation. In any event, the Fed basically, in its latest meeting, and we just got minutes this week actually from its latest meeting, there's definitely saying, hey, look, we're not going to cut anytime soon. We have to see inflation improve. We want to see more sustained evidence that we're going to get back to the 2% level. And even in the honestly in the minutes, what kind of came out, which is a bit dramatic, is now officials actually discussing the question: is the monetary policy tight enough? In other words, should we hike rates a little bit more? And overall, of course, they decided not to, but just the fact that they're putting that discussion back on the table has people's attention for sure. And ultimately, what we've seen in terms of the expectation of the Fed funds rate, that anchor for ultimately banks to set their interest rates, and it sort of cascades into the market rates. The Fed funds, when we started the year, this blue line shows that the market expected 5 to 6 quarter point cuts, and the green line happens to be the Fed's forecast. Now the market's saying, oh gosh, the Fed is, we believe the Fed now, and it's 1 to 2 cuts by the end of the year. And a lot of people are talking about moving that sort of first cut into 2025. So long story short, this means that interest rates remain a bit elevated. Markets reacted to this expectation the Fed is going to slow down, rates have come up a little bit, and all of that creates ultimately some design friction in the economy. So, again, the economy has been growing robustly. It's comprised 2/3 roughly of consumption, and so the consumer is really, really important, and forecasts have sort of ridden the wave of better than expected results, right? So we had very strong 2023 results compared to consensus expectations. And as we move into 2024, there's now a view that we're going to be, the overall estimate is 2.4% for the year. We don't necessarily see that as being wrong, but what we expect as we move through the middle of the year and into the second half is for there to be a slowdown. And how that sort of impacts the full year, who knows? But bottom line is we think things are going to slow maybe a little bit more than the consensus view as we sit here today. Now, some of the triggers for that, we're going to look at a few frictions. One is, let's start with businesses. So, interestingly, when we think of essentially what's going on in businesses, and this happens to be NFIB optimism. So these are small businesses, as it relates to almost like the expectations. So this blue line, things like expected business conditions, outlook for expansion, expected real sales, expected credit conditions, things like that. Basically, companies are a little bit less optimistic. And so that blue line basically is just sort of falling down here and is bumping around down at a pretty low level. And so people are a little bit worried about the future. And, when we turn back to the consumer, it's interesting. One of the things we can do is to look at companies' earnings and hear what CEOs and others are saying about the consumer where it makes sense. So here we have 8 different quotes on consumer spending that we've learned from this last earnings season. And 5 of them, McDonald's, Pepsi, Amazon, Citi, and Starbucks, are basically pointing out some slowdown in the consumer, especially as it relates to the lower income consumers. So we're seeing these cracks. I mentioned a moment ago the idea of consumer sentiment rolling over. Businesses are a little worried looking forward. So people are kind of worried despite the fact that we've had sort of higher levels of growth. Now, so I guess a punchline here is interest rates higher for longer, the challenge of having increased debt, a slowdown in the economy, and these are things that we're expecting basically as we look forward. Now, as it relates to the markets and market implications, this idea of higher for longer has caused interest rates to pop up since the beginning of the year. In round numbers, the 10-year Treasury is about 0.5% higher than where we started 2024. This chart happens to show 2023, but interestingly, the 10-year rate was exactly the same at the beginning of this year as to the beginning of last year. So think 0.5% up. And for bond investors putting money to work, that's in some ways appealing. Basically, all the different categories of fixed income are showing attractive yields. So forward looking, that's pretty good. Of course, those bump in yields does sort of negatively influence current holdings. We'll see that data in just a second. And then as it relates to the equity market, the discussion continues to be whether the equity market is richly valued. And when we look at it on a pure cap-weighted basis, using price-earnings ratio as the traditional metric, the market remains, by those measures, about overvalued by about 18%. So imagine, especially if there's any kind of external force or bad news, market can be very sensitive and trade down a little bit. But as we've done before, when we dig into the details, we know that the Magnificent Seven, the big tech-oriented companies, have been driving strong performance. It's really a rebound of weak performance in 22, but into 23 and into 24, basically that segment of the market, it's a big segment of the market, even though it's a handful of names, have driven higher. And so when we look at why that's happening, essentially it's around earnings growth, the ability of these big tech companies, bigger tech-oriented companies, to grow their earnings. And so, for example, in 2024, you can see a pretty elevated expectation of earnings growth, 28%. The rest of the S&P, 7%. So that's a real dichotomy. And when we look out over the slightly longer term, so think 3 to 5 years or so, the expectation is for 20% earnings growth rate annually on an average annual basis for the Magnificent Seven, and 12%, which is actually a pretty good number for the rest of the S&P 500. So when we look to the bottom left of this chart, then what this means is that people have bid up those higher growing stocks, right? So the price earnings ratio, again, for the Magnificent Seven is elevated relative to the rest of the market. But as we've looked at before, when we adjust those two things, and this time I basically took PE and divided it by that longer term growth rate, what you see is that, and this scale doesn't really show up, but in my view, the things are about equally valued. If you can see, maybe the Meg 7 is a little bit more attractively valued, but that 0.1 is, reasonable, but not huge. And so think of it as things being pretty reasonably valued at this point, looking through that lens of price earnings adjusted for growth. As it relates to market performance, in any event, that pattern from last year, which was the reverse of 22 again, continues into 2024 with the big tech-oriented companies performing better. So here we have the UBS Magnificent Seven Index. You can see the New York Stock Exchange FANG Plus Index. And we look to the bottom half of the page on the right, those figures of 20.7 and 21.2. That's basically, these are very strong numbers for a year-to-date figure in 2024, fueling a cap-weighted S&P of 12.2 versus the equal-weighted index of 6.9. And so on the equity side, that is the story that continues to be seen. I mentioned the bonds, so you can see that negative 1.3%, a modest negative return in fixed income, and that relates again to that modest jump up in interest rates. That's the effect of a higher rate. So on a current basis for current holdings, a slight headwind when it comes to putting money to work makes bonds a little bit more attractive. Now, one of the things that people tend to do is when something like a cap-weighted index is outperforming an equal-weighted strategy, which is often used in active management, a lot of times people look at that and they get attracted to it, and then they kind of capitulate and flip over their strategy. But what this chart on this next page shows is that concept of whether it's the cap-weighted index or the equal-weighted index being in or out of favor comes and goes through time, right? So there are periods when the cap-weighted index does well. There are periods when the equal-weighted index does well. And honestly, as a long-term investor, you're okay kind of using either in a way, depending on your other preferences. The key, in my view, is to stick to your strategy and be careful not to capitulate and almost like chase recent positive performance with the sort of the bias that you think it's going to continue forever when it really doesn't. This chart shows that these things come and go. Now, switching gears and talking about sort of the future here, looking forward a little bit. We've talked before about this idea that we're in a global election super cycle, 40% of the world's population going to the polls. It continues to be the case that candidates talk about economic opportunity. That translates to sort of a theme of protectionism. And interestingly, as it relates to the U.S. election, for example, we're seeing that really in terms of Biden and Trump debating, even at this stage, before the election, well, who's going to be tougher on China when it comes to trade? So tariffs being imposed and debated, and one's going to do one and one's going to double that, and all this, and which is fine, but at some level, when it comes to the way the economy, global economy works, one needs to be mindful that open markets and open trade on average just help a little bit. And also frictions that get put in place can sort of be a component or a driver, a little bit at least, of the inflation trouble that we're experiencing. In any event, as it relates to the elections, in talking to our chief strategist, Washington policy strategist, Brian Gardner, he's pointing out a couple of things that are kind of interesting. One is that, number one, the election at this stage is really a toss-up. Really hard to tell, even with polling, who's going to win what. Number two, just the way the numbers line up, there's a decent chance that we'll have divided government in the wake of the election, but a reversal of where power resides, meaning the presidency and the Senate flipping to Republican control, even as the House ends up being taken by the Democrats. And so that's something that we're mindful of as we look forward. The other thing he mentioned, which I think is super interesting, is the idea of the potential arithmetically for an electoral college vote tie. And so, these are the kinds of things that we're going to keep a close eye on, and sort of the way policy is starting to get signaled by the two sort of candidates here. It's the kind of work we're going to do as we get up to the election. But again, at the heart of it, it feels and it seems as if the election is a bit of a toss-up. As ever, we continue to evaluate data as it's coming out. We keep an eye on all the geopolitical tensions around the world and are watching for a cooler inflation, watching for the consumer to slow down, watching for businesses to slow down a little bit. And then what does that all mean, both for Fed policy and then in turn for the markets? And so that's the work that we continue to do. I would invite people, as I always do, to check out stifelinsights.com. This video, a podcast series, this slide deck, and a bunch of other work is available there, that theme work I mentioned earlier. And so anyway, thank you so much for checking out this month's investment strategy brief, and we'll see you in June. Thank you.